a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about gold ETFs. So gold has been rising this year. It's up about 10% year to date and now very close to the record levels seen in August of 2020, above $2,000 an ounce. And there are a number of factors which are driving this surge in gold prices. So the recent banking crisis that has led to concerns that the global economy could fall into a recession, and gold is seen as a safe haven asset, which does well during times of economic uncertainty. Then the recent inflation reports, CPI and PPI, both suggest that inflation has started moderating, and that has led to hopes of a Fed pause later this year. And if the Fed pauses rate hikes or cuts interest rate, that would reduce the opportunity cost of owning gold, because gold, as you know, doesn't produce any income. So higher interest rates hurt the price of gold. And because of hopes of a Fed pause or pivot, the US dollar rally has come to an end. So earlier last year, gold was under pressure despite rising inflation. Gold is seen as an inflation hedge, but higher US dollar hurts gold. So a weaker dollar makes gold very attractive to consumers in emerging markets, India and China, which are gold's top consumers. So a weaker dollar is also boosting gold prices. And then further, central banks around the world have been buying gold at a record pace as they want to diversify their assets, their foreign exchange reserves, away from just the US dollars. And in fact, according to the World Gold Council, global central banks reported net purchases of 125 tons of gold during the first 2 months this year, making it the strongest start to a year since 2010. So I believe that gold should be a small part of any investment portfolio, mainly due to its low correlation with other asset classes. So that helps reduce portfolio risk a little bit. And also, even though inflation is cooling off a little bit, but it is expected to stay at elevated levels. Some parts of inflation are still sticky. So gold can work as an inflation hedge, and particularly when the dollar is weakening. And physically backed gold ETFs, which actually own gold bars, they provide a low cost and convenient way of gaining exposure to the metal. So let's take a look at some of these ETFs. So the first one I'm highlighting is the most popular and most liquid and the oldest gold ETF, the Spider Gold Trust. The ticker symbol is GLD. Each share represents 1/10 of an ounce of gold, 1/10 an ounce of gold, which, as I mentioned, is physically backed by gold bars. Very popular, assets exceeding $60 billion, and has an expense ratio of 40 basis points. Now, you can go to the quote page on Zacks.com to read our research report and articles. You can also use the link to go to State Street webpage for this ETF, but there's not much to learn. You can read a little bit about their research, gold research, where gold prices are going, etc. But apart from that, there's not much to say because it is backed all by gold bars. Now, the second one that I'm highlighting is one of the cheapest gold ETFs. So in 2018, State Street launched this mini version of GLD. So mini in two areas. Uh, while GLD is 1/10, this is 1/50th of an ounce of gold. So that means a lower price handle, lower share price, which may, you may like that unless your broker allows fractional share trading. So if your broker allows fractional trading, then this share price may not matter to you. But expense ratio is much lower, just 10 basis points. And since its launch in 2018, it has already gathered 6.3 billion in assets because it is an excellent way of owning gold exposure in a long-term focused portfolio. Again, you can go to the quote page on Zacks.com, and from there, if you want to learn more, you can go to the State Street webpage. The third one I'm highlighting is the cheapest. So GLTM charges 10 basis points. This charges 9 basis points. But 1 basis points doesn't make a lot of difference. 40 basis points of GLD versus 10 basis points or 9 basis points is a big difference. But 10 or 9, not a big difference. So this is the micro version of IAU ETF by iShares, and this represents, the share price represents 100th of an ounce of gold. This was launched in 2021 and has gathered about $1 billion so far. And on the next slide, I have the comparative performance versus the S&P 500 index. And all these three ETFs, which track gold prices very, very closely, will give you similar price returns. Of course, over the longer term, GLD may lag a bit because of its higher expense ratio. But if you want to own gold for a shorter time period, and if you want a lot of liquidity, then a lot of trading, then GLD is the ETF for you. Or if you want to own it longer term, then take a look at GLTM or IAUM. Over the past 12 months, all three gold ETFs returned about 1%. That is despite rising US dollar, and the S&P 500 index was down about 6%. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our YouTube video channels, so that you do not miss anything. And I'll see you next week.